Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Lightwave logic.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And before we jump into the actual analysis today, we should probably mention StockOracle.
Oh, right, yeah. So we have a special 14-day trial link down in the description for StockOracle.
Just a quick heads up, it is an affiliate link. So, the channel might earn a small commission if you sign up through it, but that's at absolutely no extra cost to you.
Exactly. And we always want to be super transparent about what StockOracle actually is. It's an AI-aided stock research platform.
Right. It is not financial advice.
No, definitely not. It's not a trading signal service, and it's not giving you like real-time market data to day trade with.
And because it uses AI for its insights and, valuation estimates, those can sometimes be incomplete or just flat out wrong.
Yeah, you always have to verify important facts for yourself. We are not telling you to buy, sell, or hold anything today. We're just exploring the data and the potential setups.
Right. Both the upside and the downside. So with that out of the way, let's look at Lightwave Logic, ticker LWLG.
Yeah, so this company is fascinating because it sits right at the intersection of the massive AI boom and actual physical reality.
The physical infrastructure. Yeah.
Right, because every time you ask an artificial intelligence to, write an email for you or summarize some huge document or generate one of those photorealistic images.
You're essentially boiling water somewhere.
Exactly. It's wild to think about. We have this tendency to think of the cloud as being totally weightless. Like it's just this clean, invisible realm of ones and zeros floating around.
Right, but the physical data centers powering all this virtual stuff, they are running so incredibly hot that traditional copper wires are, well, they're literally hitting the laws of physics.
It's a massive hardware bottleneck, isn't it?
It really is.
Yeah.
We are demanding these exponential increases in data processing, right?
Yeah.
But we're trying to force all of that information through legacy infrastructure.
Okay, so let's unpack that a bit. As these large language models scale up, the actual physical servers inside these huge data centers, they have to communicate with each other instantly.
Right. The servers are constantly talking.
And historically, they've used copper cables to send electrical signals back and forth. But as the sheer volume of data just explodes, pushing electricity through copper at those ultra-high speeds...
It creates a ton of friction.
Right. And friction creates heat.
Significant heat, like to the point where just cooling these data centers is becoming ecologically and economically unsustainable for these big tech companies.
Oh, yeah.
And it's not just heat either. The electrical signal physically degrades the further it travels over copper wire. So the entire data center industry is basically being forced into this massive paradigm shift. They need optical interconnects.
Meaning they have to stop using electricity to move the data and start using light instead.
Exactly. Light over fiber optic cables.
Okay, but that raises an obvious question, right? If the whole industry knows they have to use light, why hasn't everyone just, swapped out the copper cables for fiber optics and called it a day? What's the actual holdup here?
Well, the holdup is the translation process. Because the computer chips themselves, the processors, they still process information electronically.
Right.
So to send that data over a fiber optic cable, you need a device in between called a modulator.
A modulator?
Yeah, you think of it as a high-speed translator. It takes the electronic signal from the computer chip and converts it into optical light pulses.
Got it.
Now, historically, the industry has built these modulators out of materials like lithium niobate or just standard silicon. But there's a huge problem.
Which is?
Those legacy materials are bulky. And worse, they require a relatively high amount of voltage to operate. So consequently, they still generate way too much heat when you try to push them to the insane speeds that AI requires.
Okay, this is where I really had to spend time in our research trying to visualize how Lightwave Logic is actually solving this. So, tell me if this analogy works for you.
Sure, let's hear it.
If you think of traditional copper wiring as this massive, frantic game of physical telephone, you have, like, thousands of people shouting at each other down a line.
Okay, yeah.
They're exhausting themselves, they're losing their voices, and the message gets all garbled. That's the heat and the energy loss in the copper.
That's a really great way to picture the electrical bottleneck, actually.
Right. And then even the older optical tech, like that lithium stuff you mentioned.
Lithium niobate.
Yeah, that's like trying to translate all that frantic shouting into a clunky mechanical Morse code machine. Like, it works, but it takes actual physical effort to push the heavy buttons fast enough.
Right, which takes voltage.
Exactly. So what Lightwave Logic has done is basically completely bypass that clunky machinery. They have this intellectual property moat built around electro-optic polymers.
Right, specifically a proprietary material they call perkinamine.
Perkinamine, right.
This is where we get into the really cool molecular engineering stuff. Rather than relying on a rigid crystal, like the legacy tech, Lightwave has engineered a specialized plastic, a polymer.
Okay.
And at a microscopic level, when a very, very tiny voltage is applied to this polymer, it instantly changes its optical properties. It literally bends the light.
So sticking with my analogy, perkinamine is like having this perfectly silent, frictionless, fiber optic Morse code machine that just flashes instantly with almost zero energy required. No one's shouting, no heavy buttons are being pushed.
You've nailed the mechanism, yeah. Because it operates at the molecular level, a perkinamine modulator can switch data from electrical to optical at speeds that just completely dwarf the legacy materials.
Mm.
And it does it using a fraction of the power.
So it doesn't generate that crippling heat.
Exactly. And the real kicker for the stock here is that they hold the patents for these specific polymer structures.
Ah, the patents.
Yeah. As Microsoft, Google, Amazon, as they all scramble to build the next generation of AI supercomputers, Lightwave Logic holds the legal rights to the most efficient material capable of making those speeds physically possible.
Okay, but this brings up a massive contradiction that I found.
Oh, the financials.
Yes, because if their intellectual property is the holy grail for this AI heat problem, and if big tech is spending literally billions on infrastructure, you'd think they'd be throwing truckloads of cash at this company.
Right.
But when I look at the financial data, that is absolutely not happening yet. The margins are incredibly confusing.
They are. They really require you to completely adjust how you view a standard business model.
Yeah, because here's what I saw. On a trailing 12-month basis, which for anyone listening just means looking at their performance over the past year, their revenue growth is an explosive 175.9%.
Which sounds amazing.
It does. And their gross margin is a staggering 97.13%, meaning for every dollar they bring in, they're keeping roughly 97 cents before operating expenses.
Right.
But then you look at the bottom line. Their net margin is negative 8,724%.
Yep.
And their earnings per share is negative 15 cents. How is it even possible for a company to keep 97% of its revenue at the top, but bleed out thousands of percent at the bottom?
I know, it sounds totally absurd until you understand the life cycle of deep tech commercialization. You have to realize that the 175% revenue growth you just mentioned, it's coming from an infinitesimally small base.
Oh, so they aren't actually making much money at all yet.
Exactly. Lightwave Logic is functionally a pre-profit research and development company right now. That tiny bit of revenue they're generating isn't from some massive commercial rollout of their polymers. It's likely just coming from small licensing agreements or maybe early engineering samples for testing.
Oh, I see. So that 97% gross margin basically just means the raw materials to make a tiny little sample of this specialized plastic cost almost nothing.
Precisely. The cost of goods sold is virtually zero because they're basically just selling intellectual property and microscopic amounts of polymer.
Wow. Okay, but what about that negative 8,700% net margin?
Well, that is the harsh financial reality of maintaining state-of-the-art laboratories. It's the cost of paying elite material scientists and optical engineers. They are burning millions of dollars in operating expenses every quarter to perfect the technology, but they just don't have the commercial revenue to cover those costs yet.
That puts their valuation into a very precarious light, doesn't it? I mean, we are looking at a company with a market capitalization of roughly $944.5 million.
Yeah, a near billion-dollar valuation for a company that isn't generating free cash flow.
Right, and their price-to-book ratio stands at 11.6.
Let's actually unpack that metric for a second because it's vital for understanding the risk here. The book value of a company is essentially what would be left over if you sold all their tangible assets today.
Like their lab equipment, their office chairs, their cash on hand.
Right, and paid off all their debts. So a price-to-book ratio of 11.6 means the market is valuing this company at nearly 12 times the value of its actual physical stuff.
Which means investors aren't paying for factories or current sales or tangible things. They are paying a massive premium for an idea.
Exactly. They are paying for the patents. And this deeply held belief that in a few years, every AI data center on Earth will have to pay Lightwave Logic a toll just to use their polymers.
It's the ultimate expression of pricing and future growth.
It really is.
Yeah.
And, when a stock's entire valuation is based on a future promise rather than present-day earnings, the price action becomes incredibly violent.
Violent is the perfect word for this stock chart. I was looking at the technical price action, and it seriously looks like an EKG of someone having a panic attack.
Oh, absolutely.
The stock is currently trading at around $6.13. But over the last 52 weeks, the high was $18.70, and the low was $1.92.
That kind of spread is exactly what you expect with this sort of risk profile. The market measures this volatility using a metric called beta.
Okay, beta.
Yeah, Lightwave Logic currently has a beta of 2.51. Now, the broader market, like the S&P 500, has a beta of 1.
So this stock is 2.5 times as volatile as the overall market.
Exactly. If the NASDAQ dips because of some macroeconomic worry, Lightwave Logic plunges. But if there's positive news in the semiconductor sector, this stock acts like a coiled spring.
But let's be real here for a second. A drop from $18 down to $6, that is a 67.2% haircut from its peak.
Yeah.
That is going to terrify a normal investor. I mean, if you bought near the top, you've lost 2/3 of your money. How is that not just the chart of a failing company?
Well, it's brutal if you're caught on the wrong side of that swing, absolutely. But this is where technical analysis really requires context. A 67% drop looks like a total disaster in isolation.
Right.
But if you zoom out and look at the 52-week return, the stock is actually still up 125.7% from a year ago.
Wow, okay. So it doubled, even after losing 2/3 of its value from the absolute peak.
Right. That tells us we are looking at a classic parabolic run-up that was fueled by AI hype, followed by a severe but honestly necessary correction.
So the hype bubble popped, but the underlying company didn't die.
Exactly. The market just sobered up. And what is most revealing right now is the trading volume. The current volume is sitting at only 0.45 times the 3-month average.
Meaning less than half the normal amount of shares are actually changing hands on a daily basis right now.
Yes, the trading has essentially dried up. In technical terms, this often signals what we call basing behavior.
Basing. Okay, explain that without the jargon.
Think of it this way. The aggressive sellers, the people who panicked during that 67% drop, they've finally exhausted themselves. They are out of the stock.
Okay.
So the price has found a floor, the volatility is shrinking, and we're seeing some minor stabilization.
Okay, so the panic sellers are gone. The stock has found a floor around $6. But that naturally leads to the biggest question. Who is buying? I mean, are we just catching a falling knife here, or is this $6 price tag a massive discount?
Well, to figure that out, we have to look past the charts and examine the people inside the company itself. And the insider trading data we found is, frankly, the most compelling piece of this entire puzzle.
Yeah, this stood out to me more than anything else in our research. Over the last 90 days, we've seen massive cluster buying from insiders.
Huge amounts.
We are talking about executives and directors actively using their own personal money to buy a net 70,215 shares. There were 6 separate buy transactions and only 1 sell transaction.
Right, and that kind of activity generates a specialized metric called the Management Sentiment Price Ratio, or MSPR. It essentially scores how bullish the insiders are on a scale of 0 to 100.
Okay.
Right now, Lightwave's MSPR is sitting at 99.02.
Wow. That is essentially a perfect score for insider confidence. And we should probably remind everyone listening why this actually matters so much, because a CEO might sell their stock for a dozen totally normal reasons.
Oh, sure. They need to pay their taxes. They want to buy a house. They just want to diversify their portfolio. Selling doesn't always mean bad news.
Right, but insiders generally only buy their own company's stock on the open market for one reason.
Because they believe the stock is undervalued and is going to go up. When you see executives stepping in to buy aggressively after a 67% crash, it strongly implies they have deep conviction in upcoming catalysts.
Like they know something the market hasn't fully priced in yet.
Exactly. They are seeing data in the lab, or they're having conversations in the boardroom that the public just doesn't know about yet.
So what exactly are those conversations? Our research pointed to a recent analyst report that maintained a buy rating and set an $11 price target.
Which is almost double the current price, yeah.
Right. And they specifically mentioned something called the Marvell Polariton setup. Can you translate that for us?
Absolutely. So Marvell Technology is a massive player in data infrastructure, and Polariton is a company specializing in advanced modulators. The setup they're referring to is the broader industry movement towards silicon photonics integration.
Okay.
The narrative is shifting right now. It's no longer just a theoretical debate about whether these optical polymers are cool. Major Tier 1 network operators are actively seeking out these specific optical solutions today because they literally have no other way to scale their AI data centers.
The copper wall we talked about earlier.
Exactly. And the whispers on Wall Street suggest that Lightwave logic is perfectly positioned within this new ecosystem.
We also saw some very loud rumors in the data about Fortune 500 prototypes hitting production by 2027.
And that right there is the ultimate catalyst. If Lightwave Logic can officially announce that a Tier 1 customer, a Microsoft, an Amazon Web Services, a Meta, is actively prototyping their perkinamine polymers for their next-generation server racks,
The stock explodes.
the entire valuation of the company re-rates overnight. It fully validates the technology at commercial scale.
Okay, I can feel myself getting swept up in this narrative. I mean, the frictionless molecular polymers, the 99 out of 100 insider buying score, the rumors of big tech partnerships.
It sounds great.
It does, but I need to throw some serious cold water on this right now because I have a huge red flag waving in my face regarding how this actually plays out for a regular person buying the stock today.
Oh, absolutely. We have to force a sober look at the downside. Embracing the bear case is completely non-negotiable when you're analyzing a pre-profit deep tech company.
So let's talk about the valuation risk. We discussed the price-to-book ratio earlier, but the price-to-sales ratio, it is terrifying. It's currently sitting at 3,884.
Yeah, just to give everyone listening a benchmark for that. A mature, healthy technology company might trade at maybe 5 to 10 times its yearly sales.
Yeah.
A super hyped-up, hyper-growth software company might trade at 20 or 30 times its sales. Trading at nearly 4,000 times sales means this stock is priced for absolute, unquestionable perfection.
There is zero margin for error.
None.
And here is where I get really concerned about the actual mechanics of holding this stock. If they have that negative 80 to 700% net margin we talked about, and they are burning millions of dollars in R&D, and they aren't generating free cash flow, how are they paying their scientists? Won't they just have to print more shares of stock to keep the lights on until 2027?
You've just identified the single biggest threat to retail investors in this entire space: dilution risk.
Dilution.
Because they don't have profits to fund their growth, they have to rely on the capital markets. They have to issue new shares to raise cash.
Which means if I buy a slice of the Lightwave pie today and they issue millions of new shares next year to raise money, my slice just got much smaller.
Exactly. Even if the overall pie stays the exact same size, your ownership percentage is diluted. And that puts constant, heavy downward pressure on the stock price.
That's brutal. So I could be completely right about the science. Perkinamine could be a massive success by 2027. Every data center could use it.
But you could still lose money on your investment.
Exactly.
Because your shares were diluted into oblivion over the next 3 years just to fund the laboratories while they waited for the tech to catch on.
Wow. That is a serious reality check.
And dilution is just the financing risk. We haven't even touched the execution risk.
Right, because what if that 2027 timeline slips? What if it takes until 2029 to get the polymers right for mass production?
The market will not wait patiently. If they announce a significant delay, the stock will be punished mercilessly. Furthermore, you have to remember that the AI hardware space is moving at breakneck speed right now.
Yeah, everyone is trying to solve this bottleneck.
Right. So what if a competitor invents a completely different workaround for the copper problem? If Lightwave loses a key prototype bake-off to a rival company, that $11 price target vanishes instantly, and you will likely see the stock crash right back through its 52-week low of $1.92.
So it's basically walking a tightrope without a net, which brings us to the final verdict. When we weigh the massive intellectual property moat and the insider buying against the extreme valuation and that terrifying dilution risk, where do we land?
Well, looking at the totality of the data, the analysis generates a bullish score of 7 out of 10.
Okay, a 7 out of 10 implies optimism, but it certainly doesn't sound like a sure thing.
It's definitely not. The 7 out of 10 reflects a textbook asymmetric bet. The upside is undeniable, right? You have a technology that fundamentally solves a critical physical bottleneck in literally the most lucrative industry on the planet right now.
Right.
You have 97% gross margins, and you have insiders buying aggressively at a 67% discount to recent highs. But you're investing in a promise that won't fully materialize until 2027.
And that timeline is the key takeaway for anyone listening. If you are looking at this stock, this is not a quick day trade. This isn't something you flip next week after a good earnings call.
Not at all.
The timeline requires a multi-year hold, specifically an 18 to 24-month horizon. You have to have the iron stomach to hold through wild market swings, the very real threat of dilution, and these long, grueling periods of silence between press releases, all just to capture that potential 2027 commercialization catalyst.
It requires extreme patience, a very, very high risk tolerance.
Yeah. But honestly, even if you never buy a single share, watching Lightwave Logic right now is like a real-time masterclass in how financial markets operate.
It really is.
It shows you exactly how Wall Street tries to price revolutionary, completely unproven science against the massive, overwhelming backdrop of the AI gold rush.
And it forces us to step back and look at the bigger picture, too. We spend so much time debating which company is writing the smartest software or which mega-cap tech titan is designing the best microchip.
But the real winner might just be the company making the tiny plastic bridges between those chips.
Exactly. But, it also raises one final critical question that we have to consider before we wrap up. Lightwave Logic is betting absolutely everything on optical polymers being the ultimate bridge for data transfer.
Right.
But what if the ultimate bridge doesn't use physical cables at all?
Wait, what do you mean, like wireless AI?
I mean quantum networking.
Oh, wow.
Right now, billions of dollars are being poured into quantum entanglement research, the ability to transmit data instantly across distances without any physical connection whatsoever, bypassing light entirely.
Okay, that is a staggering thought.
If quantum networking achieves commercial viability faster than expected, does Lightwave's incredible, light-bending IP become obsolete before it even reaches mass adoption?
So they are in a race not just against traditional copper wires, but against the next leap in physics itself?
The physical reality always wins in the end. The question is just which reality we arrive at first.
Man, we'll have to keep our eyes on the hardware for sure. Well, that wraps up our analysis for today. Remember, if you want to dig deeper into the numbers yourself, that 14-day trial link for StockOracle is down in the description.
Yep. Verify the data, do your own research, and manage your risk.
Thanks for listening to Smart Wealth with Joshua. Don't forget to subscribe, and we'll see you on the next episode.